Thank you for attending the webinar, guys. I truly appreciate it. I promise not to waste your time and vice versa. I don't like it when people waste my time. So I don't like when I watch webinars and they take a Sharpie, they write one word, and they talk about that one word for the next 20 minutes, and they give you juice at the end. I'm not going to do all that. I don't have time for all that. So let's get to it. It's a boot camp. My company, my school is a boot camp. So don't expect me to be super nice and smiles and giggles. No. Stock market is a war. It's a battle between bulls and bears every day. So there's times you got to be aggressive and there's times you have to be risk averse. So true professional traders, if you put them all in one room, they talk the same way. They say the same things. They are humble the same way, and they're aggressive the same way when they need to be aggressive. So if you're a professional trader, you come to a point where if you talk to somebody for 5 to 10 minutes, you know exactly where they're at, or if they're full of BS, or you know which path, which career level they're at, how many years of experience do they have, where they are at a specific point in their trading career. You can detect it like this. So I will tell you exactly that 97, 98% of the people out there, I don't trust. I don't even care about what they say because it's false. It's wrong. I can literally count on my hands how many true professional traders are out there from who are actually on social media. So it's not easy. By any means, I want to talk to you about consistency of profits. For you to be able to consistently be profitable, that means somebody else is consistently losing money to you. If you're making money, somebody else is losing money. Okay, so, and not everybody's not stupid, and you're the genius here in the room. So how are you going to make consistent profits if everybody is trying to pinch pennies and make sure they don't lose a single cent? Warren Buffett said it best. There's 2 rules to the market. 1, never lose money. Number 2, never forget rule number 1. So nobody wants to lose money. Financial institutions, large funds, they don't want to leave a single penny to you. They create algorithms. They hire quants to make sure they know how you think, to make sure that you're always pushed out of a trade as a weak hand so they can make consistently profitable trades. So it's not, don't think it's going to be super easy. There is a learning curve. I don't know how long it's going to take you to learn. If you're an emotional person like I am, it's going to take you a longer time. It took me many years to get rid of my ego. So there's some guys out there that they can get rid of their ego very quick. And this is why people say that women are better traders than men, because they don't have an ego like a man does. When a man is wrong, sometimes they don't want to admit that they're wrong. But in stock market, the faster that you can admit that you're wrong, the more money you'll make, because you can cut your losses early and move on to another trade. And that's all it's boiling down to. Not so much that it's complicated, but whether you can control your emotions, specifically fear and greed, at the right time and as soon as possible. So there's things I want to talk about in this video. One of those things is zero commissions. Again, before I used to make a lot of trades and my commissions would add up. Sometimes $500 a day, sometimes $1,000 a day. And if I'm only making, let's say, $600, $700 a day, and I'm paying $1,000 for commissions, I was at a loss. A lot of times I was making profits, but I was at a loss because I was paying my broker. Now, broker commission being zero, it's a huge boost to my bottom line. My yield went up significantly. So that's why I'm telling people to trade now, because I hope this trend stays. And I think it's going to stay. I think zero commissions are here to stay. I just hope Wall Street bets and what happened with GameStop, I hope these type of things do not force brokers to change their strategy and start charging again. And that's my biggest fear. Another thing I want to talk about again is consistency of profits. It doesn't matter that you're going to hit a home run of, let's say, $5,000. Okay? can you consistently deliver that $5,000 every month? If you're going to win $5,000 in one trade and then have minor losses or no gains at all for the rest of the month, you just made $5,000 for the whole month. And that's like having a $60K a year job before taxes. So you can't really push the needle forward if you're just making $5,000 a month, right? So in order for you to be profitable and for you to get ahead, you need to make way more money and you need to be consistently profitable. Okay, so that takes time, that takes skill. So don't think it's going to be very easy. Don't get super excited because you made a few $1,000s from a trade. Always have in the back of your mind, whether you can deliver those gains over and over. Which takes me to my next point is risk management is everything. So I think of myself as risk manager first, then a stock trader second. For me, I don't care about the profits. Of course, it's important, but for me, number one priority is to manage risk. How much can my stock lose? And what am I doing to stop that loss? How am I going to manage those losses? Everything boils down to risk management. You really cross to the threshold of professionalism once you realize that and you stop caring about the profits. The profits will take care of themselves as long as you're managing your risk correctly. Next thing I want to talk about is whether you're going to have a full-time job and then trade only an hour a day or so, or you can dedicate your entire 8 hours. Okay, this is very important because you don't have to be in front of the computer 8 hours a day. As a matter of fact, a lot of times I'm only trading a couple hours a day. The most important hours of volatility is the market open. In New York, it's 9:30. So I'm in Los Angeles. So for me, Pacific Standard Time, 6:30 a.m. I trade the pre-market, so I wake up at 5 a.m., 4 a.m. But for you to capture the most volatile periods, it's the market open. So the first hour of the market open, and then the lunchtime hours in New York, and then the last 20 minutes of the close. Anything in between that, there's a lot of algorithm-based trading. I want you to be very experienced before you start battling algos like I do. So high-frequency trading and algo trading, fractional trading. Let me talk to you a little bit about fractional trading. When you're buying a stock at $17.03, it actually goes and gets sliced and diced between other robots and algorithms with fractions of a penny. So that stock might get bought out and sold at $16.25, 0.27 cents, and then come back to you at $17.03. Okay, so there's fractional trading. I want you to understand that retail trader doesn't get to see. And this is another thing, that the level field is not truly even, and makes you sick to your stomach of how disgusting and unfair the game is to a retail trader. Institutional trading, they can trade 24 hours, they can do things that we cannot do, but we're more adapting and we can make better. There's benefits that we have that they don't, and I'll get to that later on. So another thing so full-time or part-time, you need to understand that for yourself. If you have a full-time job, you can only do an hour or 2 hours of trade. The volatile periods, like I said, the open, the lunchtime in New York, and then the close. If you have a part-time job and you can spend more hours in front of the computer, it's great. But there is a saying in Wall Street, don't trade often, trade well. So just because you're making many trades doesn't mean that it's better. No, as a matter of fact, that's actually worse. That was the problem I had to battle. I was constantly trying to force trades, and it wouldn't work out. Like sometimes less trades is more, less is more. So not always, but sometimes. Okay, it all depends on what the mother market gives you. You know, the stock market decides whether you're gonna have a good day or not. So the stock market trading has to do with a lot of waiting. So you're waiting for setups to occur. You're waiting for volatility to return. So you're doing a lot of waiting. If you if you jump in too quick or don't jump in at the right time, it matters. Okay, so and that's what you learn over time is when to stand back, when to go all in, right? Next thing I want to talk about is FINRA's $25,000 threshold. This is very important. There's a FINRA regulation that if you don't have $25,000, you can only make 4 round trips, day trades a week. So if you don't have $25,000, you should pick the best trades that you're going to do and do those trades. Okay, but once you cross that threshold, you go over 25,000, you can make as many trades as you want. Okay, so this is a good thing and a bad thing, and there's conflicting interests on that, but it's supposed to protect the retail investor, and because sometimes, again, people, novices especially, they want to overtrade because they think they're going to make more money. It's not necessarily the case. Okay, so if you don't have $25,000, my portfolio management course teaches you to pick value companies and invest in them, keep accumulating companies, good value companies, and just slowly build up your capital. And then once you cross that threshold, you can start being more frequent. You can trade more frequently. One thing I want to tell you is professional money management, professional hedge fund management is different than what 99% of the people show out there and teach out there, like these gurus on Instagram. So almost everybody is focusing on technical analysis, okay? It's the technical charting, which, you know, once you cross $25,000, fundamentals really don't matter as much. But if you're managing a hedge fund, you're managing a lot of money, then you're just focusing on fundamental analysis. You need to, Warren Buffett is looking at annual reports. He's reading annual reports, quarterly reports, versus looking at the chart patterns, okay? So, but from one earnings report to another earnings report, you really, if there's no news, there's no downgrades, there's no upgrades, all you have to do is look at the charts, right? So, and that's why most people out there are looking at charts. They're looking at golden crossovers, death crosses, and all these patterns, triple bottoms, double tops, and so forth, to make their decisions. Okay, but my courses go way into depth. For example, I talk about stock prices intrinsic value. The way you do this is you do a discount cash flow analysis, right? What is a stock price? If you think about it, what is a stock price? Most people have no idea. So stock price is what an investor is willing to pay for a company. And the way they measure that is how much a company makes throughout the whole year or quarter. So for example, let's say Apple makes $4 a share each year, right? So, and then Apple is trading at $140, let's say. So if Apple is trading at $140, that's the stock price, and Apple earns $4 a share per shareholder, per share, what is its PE ratio? Okay, its PE ratio is price over earnings. That's $140 divided by $4. That's equals to 35. So investors are willing to pay $35 per $1 of Apple's earnings. Do you understand? So how can you gauge that? How can you know how much our investors are willing to pay tomorrow, right? So if Apple is at $140 a share right now, that means Apple shareholders are willing to pay 35 times more than its $1 per $1 of Apple's earnings. Okay? Some companies are trading 100 times earnings, 200 times earnings, and that's when things get ridiculous, like they did with GameStop. And that's why bubbles happen, and the bubbles burst. And before bubbles burst, you want to short sell a stock, a bubble bursts, you buy it to cover afterwards, and you make that profit. So there's a lot more to learn in fundamental analysis, which is what I based my courses on, because my school is a professional institute. It's not a oh, come learn technical analysis and go have fun. No, it's even technical analysis has so much more that people don't talk about. For example, I talk about iceberg trades. Most people have no idea, especially retail traders have no idea what iceberg trades are. Iceberg trades is when hedge funds and financial institutions, they actually hide majority of their order so that in order not to create a panic. So the term iceberg means that you see only part of that trade, right? Think about logically. If you're a large fund like UBS Citi and you're about to dump 20 million shares of Apple, okay? Do you think you want to let that known to the public? Because that's going to create a panic and it's going to drop the stock. So you want to do it incrementally so that you don't disrupt the flow, but you're slowly exiting your position because it's really hard to fill 20 million share order. So Citidesk, UBS, Trading Desk, they slowly, incrementally exit these trades without letting the retail trader know. And this is why only technical analysis alone is not going to solve all the problems. You got to know these pitfalls. You got to know these risks that I'm taking on a daily basis. So the more prepared you are, the better off you are because, like I said, this is a war. Stock market is a war. It's a war between bulls and bears, and it's a kill or be killed mentality. There is no middle. Okay, when I lost $6,000-7,000 of my student loans on an options trade, making a stupid mistake, nobody came and patted on my back and said, "Edgar, it's going to be good tomorrow. Edgar, everything's going to turn out." No, I come back with my own money. I go work. I come back, and I'm here to fight again. It's just, how many times are you willing to get up and keep fighting and keep improving until you master this? Okay, so don't think it's going to be easy. Everybody who tells you that it's going to be easy, it's lying. So there's a learning curve. You just have to take baby steps, keep learning, and keep trading. Okay, don't think you're going to read books and everything's going to fall. No. I've read many books and I was still losing. That has nothing to do with it. Nothing can change your situation without actual experience, with actual money. Paper trading with fake money, it's like playing poker with fake money. You're going to go all in constantly. No, you need to lose. You need to fear and have risk management techniques based on your personal circumstance. If it's hard for you to save $500 a month, that means you're going to be more risk averse. You're going to be like, all right, I want to trade Apple. I don't want to trade these risky stocks like GameStop, okay? Worst case, Apple is going to go down to 100. Oh, wow. Like worst case. That's not even probable in the next couple of years, at least for now. So you focus on mega caps, large companies, Bank of America, Chevron, if you're risk averse. If money grows on trees for you, you're a trust fund baby, you have a lot of millions in the bank, and you're making side income from other things, then yes, you can push the risk and gravitate towards micro caps and small caps, right? So I don't know your personal circumstances, okay? Over time, as you get better, you will know your risk appetite. And the last thing I want to talk about is my hedge fund, Avalanche Partners, right? Avalanche Partners is a private equity capital management fund. And if you take my courses, you're automatically in. If you can invest in my company if you take the courses. If you don't take my courses, then you just don't have access to my company and you can buy shares. No, it doesn't work that way. So in order for you to invest in my company, you don't want to trade. There are certain questions I have to ask. We have to sit down and talk for like 30 minutes for me to know whether I can accept you in my fund. But anybody who takes my courses automatically has a green light to buy shares in my company. So that's about it, guys. I want you to look into my courses. I'm going to have options courses and futures courses. in the future. But right now you have my portfolio management and stock trading, day swing trading, value trading course, which you should take, and it will take you baby steps on what you're supposed to do, from picking the right brokers, from picking the right strategies, learning basics of fundamental analysis, learning technical analysis, and that's about it, guys. I will create more courses as I go on, but I wish you the best of luck. And if you have questions, feel free to reach out at support@stocksbootcamp.com or support@avalanchepartnersinc.com. All right, guys, thank you for watching. Short and sweet. Hopefully you learned a lot in this webinar, and I wish you best of success. Take it easy.